Hi, okay, so what I'd like to do is review the first few entries that we learn about in the retail chapter. So I've put some journal entries here and we're going to journalize them together. Alright, so we purchased inventory 110 net 30 for $5,000. So these are our credit terms, and if you ever see credit terms then you know it was on account because they're asking you if you pay within 10 days you can get a 1% discount. They would only give you that if you purchased it on account. Alright, so on May the 1st, I got some inventory. So inventory goes up with a debit, and accounts payable is a liability, and so it goes up with a credit. Alright, so as we do this, we're going to just look and see what are the impacts on our T accounts, because in the very end, it's going to make everything make sense if we can watch those impacts. So I'm going to make a T account for all of our information and see what's going on here. So I'll post my journal entry to my account. So inventory was a debit of $5,000, so I'm going to put that in the left-hand side. And accounts payable is a credit of $5,000. So right now I have inventory and I owe some money for that inventory. On May the 2nd, I returned some of that. So I returned $1,000. So I'm just going to undo this entry. In other words, flip it. So what I mean is before I credited accounts payable, so now I'm going to debit accounts payable. And I'm going to credit inventory because I sent some back. So that's for $1,000. So let's go ahead and see what that looks like in our T accounts. So accounts payable, I debited it for $1,000. So right now I can look and see I don't owe $5,000 anymore. I owe $5,000 minus $1,000, so I only owe $4,000. And for inventory, I credit it for $1,000. So I used to have $5,000 worth of inventory. Now I just reduced it by $1,000. All right, and so the next entry is going to be me paying for it. So I have to do a little bit of calculation here, but nothing too crazy. So I pay for the inventory within the discount period. So the first thing I'm going to do, whenever I pay for something that I owed, I need to look into the accounts payable account and see what I owe. Well, I add my credits, subtract my debits, I can see that accounts payable has $4,000. So the balance is on the credit side because that's the biggest side. So to get rid of it, I need to debit $4,000 to accounts payable. I do the whole amount because after this entry I don't owe any more. Now I'm going to do two calculations here. I'm going to say, well, I'm going to pay cash for this, but I'm going to take a discount. So I'm not going to pay the whole 100%. Instead, I'm going to pay $4,000 times 100 minus the 1%, so 0.99. That's how much I owe. $39.60. That's how much I'm going to pay. And again, I do that because if I get a 1% discount, that means I'm paying 99%. All right, and then I'm going to credit inventory because before I put the whole $4,000 to inventory, but as it turns out, that's not how much I'm going to pay for it. So I need to put my discount into inventory. All right, so to calculate, excuse me, the discount amount, I'm going to say equals $4,000 times 0.01. And that is the amount that I will credit to inventory. And I can see that this balances out. On the debit side I have $4,000. On the credit side, $39.60 plus 40 equals $4,000. So I'm in balance. So let's see what this does to our accounts. Accounts payable got debited for $4,000. Cash, I paid out $39.60. I can't really look at the balance because I don't have my previous numbers in there since I made up this problem. And inventory got credited for $40. All right, so right now I have inventory. Let's go ahead and get our ending balance. So to get an ending balance in a T account, we start with the normal side. So I add up my debits and subtract out the credits. So 5,000 minus 1,000 minus 40. So I can see that my inventory is valued at the amount that I really paid for it. Let's see how much is in my accounts payable account. So we start on the credit side and subtract out the debits. And it should come down to $0 because we've already paid it off and we don't owe any more. Alright, so now let's make our first sale. So we sold the inventory for $6,000 on May 31st. Sold inventory. Alright, so we're going to have cash goes up for $6,000. Our revenue account is called sales, and it goes up for $6,000 because that's what we sold it for. And then we're going to do cost of goods sold for the amount that we paid for it. And I gave it to you here. I said the cost of the goods was sold for $39.60. But you can verify that because you can see that I'm just selling this one piece of inventory, and it did in fact cost me $39.60. So that is my cost of goods sold. So I'm going to put $39.60 here. And once I sold it, the customer took it out of my place of business, so I don't have it anymore. So the inventory that I sold needs to get credited to show that I don't have it anymore. So let's see what the impact is. I got cash of $6,000, put me back into a positive situation, so that's a good thing. And then I have sales of $6,000. And then I had cost of goods sold of $39.60. And I got rid of my inventory, so I credited inventory. So my new balance in inventory is now 0 because I sold it all. So I have to value it right so that it can work out like that. And accounts payable is still 0. I still don't owe anything. Got some cash now. And if I needed to see my gross profit is sales. Well, how much is my sales? $6,000. And then my cost of goods sold was $39.60. So I can see that my subtotal here for gross profit on just this one entry is the difference in sales, cost of goods sold. So I marked my product up $2,000, $2,040. So this is an example of buying inventory at a discount and paying for it, and then selling that same inventory. So let me know if you have any questions. Thanks.